Hello, everybody. This is Bob Woosley. I'm here on the Private Equity 360 video interview with my friend Chris Lawrence, and we're going to be talking about secondary funds today. And this is a really interesting topic. Chris and I have been friends for many years. Hi, Chris. Let me introduce Chris and put my glasses on for a second. But Chris Lawrence is a founder and managing partner of Labyrinth Capital Partners. He's worked in private equity for more than 25 years, and has led or co-led 56 private market transactions, all with emerging strategies mentioned, and represents over $620 million in deal commitment. And that's probably just shortchanging you, Chris. So I'm going to flip it over to you and have you introduce yourself, and then after that we're going to talk about secondary funds. A lot of people don't understand what they are. And then we're going to go a little bit deeper. And I know our listeners and viewers are interested in how the pandemic is impacting the secondary strategy. So let's start off, tell us a little bit about yourself and your background and how you arrived at secondaries.
That's great. No, I appreciate it, Bob. So let's do the quick history. About almost 12 years ago, my other partner, Tim Brody, and I restarted a secondary practice at our prior firm. And we ended up raising and deploying about $1.7 billion in aggregate. And as you mentioned, about $600 million was under my watch, specifically on deals that I was sourcing and executing on. But our objective there was very simple. We were really trying to achieve what was a sort of nuanced market that was gaining sort of some speed as it relates to maturity. And really at its core, Bob, it's about, when you hear the word secondary, the definition of the late 90s into the early 2000s was very simple. I'm going to bring liquidity to an illiquid asset class, and that mostly being private equity. So the idea here is very simple. When you're dealing in private markets, you're not in a public market. There's no quick way to sell a stock. You've got to find liquidity by other means. And that's kind of the strategy that now has grown into almost a $90 billion a year transaction-oriented market. So that's what we did there for about 11, 12 years. And then starting in January this year, I decided to break out on my own because I saw another area that's expanding within that market. And went after that, and I formed Labyrinth in January of 2020. We're hard at it as we speak in the middle of the summer.
And it's going to be interesting timing, Chris, because you and I have known each other for a long time in your prior firm. And I know that it was an interesting time. You spun out and started right before the pandemic. So I know we're going to go a little bit more into that. But,
sure.
But before we do that, let's go a little bit more into like an example of a secondary transaction. You've helped educate us, and we do a lot of fund administration on secondary strategies. But maybe just really dumb it down. Go through a transaction that might be ripe for a secondary strategy and why investors like it so much.
Yeah, absolutely. So let's just take an easy one. So as we all know, that the market itself is really predicated on the fact that there is a private equity fund that gets raised by a general partner, and he's raising capital from limited partners. These limited partners, these stakeholders can include endowments, insurance companies, pension plans, high net worth individuals, et cetera. So they all commit to this general partner and to this private equity fund. And let's say that they raise, for ease, $100 million from 10 LPs, and they're doing great on a buyout strategy in the small cap space. But what happens is, over the course of time, not all LPs are equal, right? Each one of the LP types that I just mentioned to you may go through various points of time within their own portfolio that they need some sort of liquidity. It could be, as from a high net worth, could be a divorce, or it could be a pension plan that's looking to kind of repivot into another strategy, or could it be a university endowment that wants to go build a building? Okay, it could be whatever it is. So typically, sometime on a normal 10-year life fund, which actually stretches probably more to 12 in a private equity life, some point in time, let's typically say somewhere around year 5 and later, those liquidity issues emerge, okay? And in that context, in the early 90s, there was no place to, quote, sell your interest for liquidity. There was no bona fide market where you could actually say, hi, I'm Mr. University Endowment, and I want to go build this new lab. And I want to sell my LP interest now that I'm fully committed and I've gotten about all my capital back, and there's just a little bit left in the tail. That's how the secondary market really sort of started. So very easily, it's a place now where private market investors, and what I call a traditional secondary, which is an LP inside of a fund, is just simply looking to sell their LP interest to a new buyer, okay? And I affectionately call those buyers substitute limited partners. If you think about it, this is a university endowment. He's going to sell to this guy. And then next thing you know, this guy goes away and then the new guy is left holding the LP interest going forward in that fund. Okay. There's a couple of key attributes though that go along with that, right? Because if you think about it, the risk profile of that buyer, of that LP interest from the university that's selling, the risk is actually a little bit lower typically. Why is that? The reason is that if you look at the original investment made by the university endowment on day one, they were crossing their fingers and hoping that that GP was going to do really well, right? They're hoping that they're going to make good investments over the course of time. Well, as a secondary buyer, in year 7, when the university wants to go build that lab and sell their LP interest, guess what? The visibility is now present, right? The portfolio is now visible, right? There's operating metrics, there's performance measures, there are all these types of things now as a secondary at it that don't look as much risky because I can do diligence on that with the GP or independently. So the return profile as it relates to generating that liquidity is typically thought of being a little bit lower and focus more on the fact that I'm buying a mature asset that should have good downside protection, that should have some form of liquidity coming sometime near in the horizon in either 1 to 3 or 4 years. And therefore, a typical return expectation on an unlevered basis in secondaries is somewhere in the mid 1.5s and sort of mid-teens IRR. That's the expectation of that type of traditional LP trade.
Less risk, right? More safety. You have more knowledge of the asset. How does a GP normally feel about secondary funds coming in and helping monetize an LP or get them out of the deal? Talk about, are there differences in how GPs, general partners, think about that?
Yeah, it's a great question because, you know, as any infantile market started to gain traction in the early 2000s, GPs haven't really woken up to the fact of, well, I really don't care who steps in so long as they can meet the next capital call for a deal or for management fees. They really didn't care. So long as the checkbook was good enough from the substitute limited partner. That's changed. Okay. And guess what the catalyst for that change was? The catalyst was the global financial crisis, right? All of a sudden, you had private equity funds where GPs were trying to call capital to protect their portfolios in the middle of 2008 and into 9 and even into 2010. But there was a lot of pain in the system for these limited partners that basically were not able to have the cash necessary to meet those obligations. So all of a sudden, the sensitivity that a GP would look at and say, well, wait a minute, I really need to make sure that my LP group is, you know, solidified, right? That it has good capital. And just as important, you want to make sure that that's your franchise if I'm the GP, because you really want to take the LPs that just invested with you in Fund 1. You want to make sure that they're groups that are going to come to you in Fund 2. So let me play the string out one other way. What's important is a GP now today looks at it, is that if an LP is selling out of their fund, they've either changed a strategy or they've lost favor with the GP or whatever the reason is. The GP will now be a little bit more active today than they were historically. And the reason for that is that they want to find a substitute limited partner, not just to be there for the next capital call, right? They're looking for a general partner or a limited partner to come in that's hopefully there for the remaining of the capital calls that are coming in that fund, but then also obviously the ability for them to participate in the follow-on funds in which the GP is raising.
I mean, the substitute LP, in your case, the secondary fund comes in and they've got to prove their staying power. I mean, they're typically smaller, right, than the original LP. Is that a fair question?
It's a fair point, but not today anymore. I mean, now you can look at it. I mean, you're correct. I think when GPs look at secondary buyers coming in, okay, it was normally, who cares? They can meet the obligation. They got capital to meet my capital call. What's happened is that you started to see the expansion of where these secondary funds will also now participate in order to kind of, quote, get the secondary deal. They'll provide primary capital into the next fund. We call those the staple transactions, which are an effective tool being used by general partners here over the last 10 years to actually create an incentive to make sure that they've got capital coming in from an LP that's selling, that's no longer going to be investing with them.
Yeah, fascinating. So really a secondary player or substitute LP, it's good for the LP who wants to get out.
Yep.
You know, and it's good for the GP because they get continuity. They get an LP who's interested, right? And it's good for your investor in your fund because you have less risk, more visibility to the portfolio. It's not like you're taking as big a gamble on the front end. I mean, Is that kind of?
Yeah, you got it right. I think the key is that, again, looking at the risk profile, when you think about a secondary fund, okay, at its core,
Yep.
and, obviously there are larger funds out there today with some of the big boys raising over 12, 15, even $19 billion funds. But what you're really looking at as an investor in secondaries is you're creating an opportunity. So if I give money to a secondary investor, okay, what am I really buying? Well, ultimately, if that secondary investor goes out and does, let's say, 20 LP transactions through the course of their portfolio build, that may actually aggregate to, let's say, 100 companies. Okay, so let's think about risk from that perspective. The 100 companies, assume that they're good companies, that's an immense amount of diversity, right? So even if a few of those end up going south and go into bankruptcy and you lose it, there's still probably 92 other companies that are going to do well to protect your principal capital. So you can think about it from a risk profile that when you get into these secondary funds, you're automatically building a very expedited large portfolio of companies in a least risky way. Okay, this is all assuming that you're buying it at a good price. You've done your work with the GP, you've done the work on the assets, et cetera. But most professional secondary guys, given the maturation of that market today, is relatively simplistic. There's a qualitative and a quantitative aspect, right? So if you think about it from the standpoint of making just a regular commitment like the university endowment did to that GP in Fund 1, right? Most of that's going to be qualitative with some quantitative analytics on the deal track record and attribution, right? There's going to be a lot of industry sector focus. There's going to be calls and references and things of that ilk. When you're doing a secondary, you're going to be asking somewhat similar questions as it relates to the GP's capabilities, but then you've got a little bit more history to look at the GP's capabilities. And then, oh, by the way, you have a whole quantitative analysis. You can start looking into the portfolio that they've already built.
Let's move to the pandemic. So this is my, less informed view, but if you think about it, you have secondaries, less risk, more safety. We just talked about the value proposition. Now here comes a pandemic. And if you've been hearing some of our other interviews, it's been crazily interesting about how LPs are reacting. Funds that have called capital and thought they were going to be opportunistic, but they didn't. They weren't at the moment. But can you just kind of paint the picture of how you think the pandemic's impacted the secondary industry and maybe what the opportunity might be as a result?
Yeah, so let's use a little bit of history because it's always good to at least take some good learning points on what we did well, what we did not do well previously. And I think the global financial crisis, there are some similarities to what happened then and to COVID. However, there are some distinct differences today in the marketplace in which we're interacting. We'll touch on this. So if you think about GFC just as a placeholder for looking back in history, when the Lehman crack happened in September in the public markets, right, it really put everybody on their heels to where everybody kind of went back and said, okay, what the heck, right? What do I do? Portfolios, I have no idea what they're doing. Public market valuations are coming down. There's no way I know how to transact when there's such a disparity of a gray fog of information that's going on. And what happened in the secondary market then, it took 60 to 90 days for both buyers and sellers to figure out whether or not they were going to agree, A, on what they were going to sell, and B, what they wanted to buy, and then C, at what price. And that took a lot of time to work out through 09. Okay. So you had a shock to the system, and ultimately it kind of worked itself out, all under the guise that we had a financial capital system that was under pressure for the reasons that we all know back then. Fast forward to COVID. Okay. Major shock, right? March pandemic, bang, March 11th. Next thing you know, everybody stops. But you can see very quickly that we've had that same shock and awe going on in March into April where people are like, I can't buy anything because I don't know what happens. I don't know what the future holds, right? At the same time, some people were saying, well, I don't know what really to sell because I really don't know whether or not I'm out of money. Now, the problem was some people know that they have a public holding that just went like this. That's what happened for everybody during March and April. There was some distressed selling going on, but very limited. You saw some, what I'll call peak deals getting done where GPs were reaching out to loan providers to provide some extra layer of cushion at the fund level to make sure they had enough capital to protect their portfolios. But guess what? Unlike the global financial crisis, the public markets ripped up. So now there's this sense of, false sense of security in my mind that through May into June, people are seeing the nice NASDAQ go crazy and all these companies, going through new highs, et cetera, that the pressure felt off, okay? But here's the problem. In a traditional limited partner sale, you're lacking the visibility of what's happening both to the marks and what's actually happening to those companies, because you're still unsure because of what happened to the economy. So as we sit here today in August, and if you talk to most people in the industry, of course, there have been some LP traditional deals being done, but the volume there because you couldn't trust the 331 marks because you had no idea what was coming in the second quarter. And in the second quarter, you've got this public market run back up where sellers thinking, well, look, the public markets are here. And buyers are like, yeah, but we still don't know what's going to happen. So that little dance card of getting together is not at the peak volumes as what we saw obviously a year ago. And I don't think it's actually going to work itself out until later in the year, until there's more visibility on some of these companies that are going on. So from a COVID perspective, of course, as any, quote, distressed buyer, because we're supposed to be, as Buffett says, right, we're supposed to be a little bit greedy every now and then. Well, yeah, we're supposed to be greedy. The problem is greedy on what? So being careful of not, and I never thought I'd say this again, but sitting there saying I'm going to catch a falling knife. Okay, that's what we all said back in 08 and 09 and 10, right? Was, God, I hope I don't catch a falling knife. Well, we're in the bottom of the first inning of this thing right now, and everybody's saying I don't want to catch the falling knife. And that's a little bit of why the volume hasn't picked up as much. But I think we're going to start seeing some shifting as we move into the back half of the year as people start to reposition the portfolios for year-end allocations. So we'll see what happens.
And it seems to me your strategy is a secondary strategy as that volatility or uncertainty starts, becoming less as the year progresses. I mean, it seems like it plays into your hand. So because you have to have LPs that are thinking about liquidity or maybe getting out of deals, that can only be good for you, right? Am I hearing you right?
Our strategy isn't no longer LP interest, but for the majority of the market in the secondary, the guys that are doing that, there's absolutely going to be some what we call turnover. Okay, there will be some need, because I think we have to be a little bit more honest with ourselves and understanding that any portfolio manager, despite what's happened in their publics, okay, we have a lot of things that are on the tape coming up in the next 4 months. We got elections. We've got 930 marks coming out. We've got one more stimulus, the third one coming out, right? So all of this artificial stuff at some point will stop, and we're going to have to be able to leg it out on our own. Some businesses will not be able to make it. They're treading water right now, right? The ability for some of these LPs to seek liquidity will become more, I'd say, urgent as you move into the fourth quarter, into the first part of next year, as more of this stuff start to filter through, because what's happening in the public market is not, in most cases, what's happening on the private side. Now, there are exceptions, right? There are companies that we've looked at that have tailwinds because of the COVID situation. But of course, there are going to be other situations that are not going to be as, I'd say, optimistic, given the fact that some of these businesses absolutely have just been extremely hurt by what's happened with sort of the shutdown over the last 4 months.
Yeah, this has been great, Chris. I don't know how comfortable you are talking about your individual strategy, traditional, non-traditional. I know that what you do is pretty innovative, but I'm happy to have you talk a little bit about how you see it.
No, I appreciate it. No, I think, Bob, the key is that, when I got into this business on the traditional LP side, it was a nuanced market. It wasn't highly competed for me. There was a lot of private market alpha you could do, because by definition in private markets, you're in an information asymmetry environment. That market has matured. Just like all markets mature, compression happens, competition builds up, and et cetera. What we were doing even 10 years ago, that was actually looking at not LP interest opportunities, but really attacking private markets in general, okay, which is finding other ways, some acquisition techniques to get after private market assets in other ways. Okay, you may hear the term GP-leds or direct secondaries. We will do some of those things. But I think in general, people have to recognize that the market out there in private markets as we sit here today is over $4.5 trillion. Okay, that includes private equity, private debt, and everything else. Okay, not real estate and those things. My point is this: the market today is 2.7 times bigger than it was in 2010. There's a lot of opportunities out there, not just with private equity firms, but other stakeholders in private markets, which will be family offices, corporates, or institutions.
Yeah.
So Labyrinth is formed, okay, not to go after the LP side of the equation, but still use some of the same stigmatisms of secondaries providing value by generating liquidity in private market assets. I'm just choosing it to do it in a different way. And I'm also a little bit more patient. So what I want to do is buy good assets at good entry points and ultimately let them grow over time. So I'm a little bit more focused on money multiple than IRR. And I think the opportunity set now is there for those types of liquidity solutions that we've been working on.
Well, Chris, I think that's great. And I know at the end of this video, we'll have your contact information if anybody wants to reach out to you just to talk shop or talk to you about your new fund, which I think would be great. This has been very educational for me. I can't tell you how many people have come to me and asked me a little, about what our opinion is on secondary funds, because we administer some, and in talking to you, I just think it's been something I've been looking forward to talking to you about. And I'm wondering if it makes sense. I'm talking about other guests about this. Maybe, you mentioned all these things are going to happen in Q4, the election, number one, and, the stimulus. I'm wondering if it makes sense for us to reconvene maybe later, this fall.
See what happens next.
Get an update, because things. I mean, the one thing for sure, it's going to change.
Yeah.
And we don't have a crystal ball, but are there any parting words you want to say? I know we're kind of getting close to our time. Anything else you'd like to add?
I wrote a piece about a month and a half ago or so, just to basically, and I'll put it back out on LinkedIn probably this week. But the whole point is that when you're investing in private markets, okay, it's times like this in the middle of COVID where you want to stay consistent, right? You want to make sure that you understand, and you're going to challenge yourself. You should double challenge yourself. And I'd say this I was actually speaking to a CIO of a very wealthy family office the other day, and I basically said, this is a point in time where re-ups are not just automatic. We may be in what will be perceived an opportunity where entry point pricing could be very attractive for certain strategies. So stay in private markets, stay convicted, be patient, but don't sit on the sidelines. That's what I would say.
Right. Yeah, makes a lot of sense. Well, Chris, I've enjoyed this. Thank you so much. And again, for all the viewers and listeners, we'll have your contact information. We will revisit with you, and I really appreciate it, man. Thank you very much. And thanks for joining us. Really appreciate it.
Thanks for listening to one of Frazier and Dieter's branded podcasts. To learn more, connect with us on LinkedIn or visit us at FrazierDieter.com, and be sure to subscribe so you never miss an episode.